Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, August 1st, and then we'll see how things look for Wednesday, August 2nd. We had a slight down day. So far, it looks like the market's holding up fairly well. We're in that seasonally weak time right now, and so we could be seeing some downward movement because of that. We're also working off being in an overbought or in a situation where we're more extended to the upside. And in some ways, this might be like a self-fulfilling prophecy. The market thinks we're going to be weak right now, so that's what ends up happening. But we just keep an eye on the charts to reach our conclusion and then go forward from there. We're still wondering, is this positive scenario going to continue? There's some things that are happening right now that might put that a little bit into jeopardy, and I'll go through that. Also, please note that I am tinkering with the thumbnails a little bit. I got some feedback, and it's kind of interesting. The feedback that I got said, keep them real, keep them simple, keep them down to earth, where a lot of the things I've been studying say, no, you need to go after the emotions, you need to scare people, you need to put fear in them, you need to make them curious. And that kind of goes against my nature, where I'm more, hey, I just want to tell you this is what it is right here, and if you like it, click on it and see if what you see ends up being helpful to you. So I kind of go back and forth with trying to put my personality into what I'm presenting as far as the thumbnails are concerned. Also, I really want to extend a thank you. I got a lot of feedback after I announced that I went over 1,000 subscribers, and your comments are just wonderful. And you're all amazing people. I wish you nothing but success. And if there's any way I can help, even in a small way in that journey, that's what I want to do. That's why I do this whole thing. Now, let's go back and talk about what happened. At the open, we did see a lower open, not much of a gap, but prices dropped to below S1 at 45.77. We never got down to S2. We did try to bounce back up. There's the opening gyration that occurs. The daily pivot at 45.85, that acted as overhead resistance. Then as the day went on, prices just chopped above and below S1, and we closed right about at S1. We were down 0.27% on below average volume. We're still positive overall. The market's holding up so far. And as I go through the charts, I think you'll see that. It's all about inflation, and right now, even a little bit more about interest rates. We saw them really climbing on Tuesday. That spooked the market a little bit. We're wondering, are we seeing a bit of a shift there? And is that going to put our positive scenario in danger of actually switching? We're still dealing with earnings season on a case-by-case basis. A number of big-name companies have reported, and I'll just mention them here in just a moment. So what are some comments that we can make? Fitch came out and downgraded the U.S. credit rating. Also, earnings reports were pretty much taken as negative. We had some big-name companies come out like Norwegian Cruise Line Holdings. Zoom came out. That was the real darling, with the lockdowns. Now they're seeing some trouble. And Uber also had a disappointing report, but the Dow ended up finishing higher when Caterpillar came out with their earnings report, and that kept the Dow positive. Rising interest rates did cause some concerns. The 10 years, what I focus on the most, we got back above 4%. That spooks the market a little bit. Small caps came back down below resistance, where yesterday they had closed above it. And then we keep asking the question, will the positive scenario continue? That we'll have a soft landing, that the Fed is almost done, and that earnings going forward still look positive. On a short-term basis, we just have the stochastics now. We've been working off this overbought or extreme positive situation. Intermediate term, we still have the rate of change 50, the PMO studies, the Sean trend meter, and the BPI for the S&P 500, as well as the NASDAQ 100. On a long-term basis, the moving averages, they're coming down, but they're still kind of looking extreme, and I'll show you that chart. The dollar was up. It had a pretty good day. It wasn't up quite 0.5%, but it's seeing a nice little rebound right now, and interest rates were also up, and that ended up impacting stocks. The yield curves that we watched, they're still inverted. And we're still extreme positive with sentiment. It was unchanged at 77. Our trend is still positive, but the green line continues to come down. However, it's on top, so we would default to the positive trend. The ADX is still above its moving average, and both the ADX and its moving average are above 40, so they're still looking rather extreme. Our bias, I've kept it mixed. Even with the slight down day, the fact that the market seems to be holding up for right now, that's kind of positive, at least for right now. And I'm keeping our momentum at mixed to positive. The economic reports that came out, we had the S&P Global U.S. Manufacturing PMI, the final reading. It came in at 49. Last time it was at 46.3. Please note that it is below 50, but it is showing improvement. The ISM Manufacturing Index, this was the big one. It came in at 46.4. They expected it to be at 46.8. Last time it was at 46, but also note that we're below 50, suggesting there's a contraction in the economy. Total construction spending was up 0.5% month over month. They expected it to be up 0.6%. Last time it was up 1%. When you take total private construction, it was up 0.5% month over month. Public construction was up 0.3% month over month. On a year-over-year basis, that equates to 3.5%. The JOLTS job openings, it did decline. It's at 9.582 million. That's still a lot of jobs, but it fell from the 9.616 million that we saw last time. Here are some charts to back that up. Here's the manufacturing PMI, where we have been seeing some improvement, but we're still below 50. We look at the ISM index. This was the big one. The total is the blue line, where we're still declining. We're below 50. Where the orders, which is the yellow line, they are seeing some improvement. ISM prices and deliveries. The blue line are prices. They're flattening out a little bit. Deliveries are starting to go up a little. That could be an improvement. The ISM trade, you have exports, which is the blue line, and that's declining, and imports are going up slightly. And then when we look at the index month over month, it was not really all that changed from one month to the next. But when you look at the longer term trend, it has been coming down. Construction spending year over year, after hitting a low, it's starting to show some improvement. When we look at private construction spending, we have residential showing some improvement, but still below zero. Non-residential is above zero, but showing a bit of a decline. Construction spending month over month, it did decline from the previous month, but is still rising overall. The job openings, we are seeing a decrease overall when we topped out in early 2022, and now this has been falling, but it's still a pretty high number. I ran across an interesting chart. I actually meant to show this in yesterday's video. This is from Sentiment Trader, an excellent website. But when we see the S&P 500 after 5 straight up months, what happens when we get out 9 months? And we're pretty much positive across the board, with the average return at 9.8% as well as the median, and the win rate is 97. So that's pretty positive looking forward. Now, you could go out a little bit further and look out 12 months, 18 months, and then going out 2 years with pretty positive returns, both for the median and the average. This is when we came out with the downgrade. Fitch downgrades U.S. credit rating. That's from the Wall Street Journal. It just says the agency said that the downgrade reflects an erosion of governance. Now, that could mean a lot of different things. The rating in the U.S. now stands at AA+, or one notch below the AAA top grade. Janet Yellen chimed in and said that she strongly disagrees with Fitch's downgrade, calling it arbitrary and outdated. She could probably put that on her own dating site. Larry Summers, somebody that a lot of people listen to and respect, where he says the U.S. faces serious long-run fiscal challenges. But the decision of the credit rating agency today, as the economy looks stronger than expected, to downgrade the U.S. is bizarre and inept. So you got a lot of people that didn't agree with this. But for whatever reason, it's the conclusion that Fitch came to. Fitch is one of the big credit rating agencies. You have Standard & Poor's and Moody's. Those are the two big boys. And then kind of in a distant third, at least to my understanding, is Fitch. Looking at a weekly chart of the S&P 500, we have some different support and resistance levels on here. This is put out by Bank of America. I try to hit these things in the videos where we talk about this, but this just gives you a little bit of a different look. Now, we also are dealing with the ISM Manufacturing PMI, and on this chart, it compares it with the industrials and the semiconductors year over year. The blue line is the ISM Manufacturing PMI, which continues to decline. Industrials and semiconductors year over year have been going up, but have fallen back recently. Then we're looking at consolidated equity positioning. It's trailing off a little bit, but still above zero. Looking at the seasonality, this is what I've been focusing on, and a lot of people seem to be talking about right now. How does August look? We tend to be down 0.02% overall in the third year of a presidential cycle, which you could also call a pre-election year. SimpleVisor, they came out with their technical overbought oversold composite. We're still getting a high reading at 91. Again, there's two ways to look at this. We're extended to the upside and due for a pullback, or this is suggesting good momentum. We've been up here now for a while on this chart, so right now it suggests good momentum, but to see the market pull back from here is not necessarily a surprise. The Dow made a new record with 13 consecutive days of gains. That was a few days ago. It ended up breaking that streak, but that's usually a positive thing, even when it's a minuscule advance. And then this one is the S&P 500, that's the blue line, and then we have an inverted look at the CPI year over year and how they have a tendency to go in the same direction when you invert the CPI. This is a chart that I show every week in the weekly video to see if we're going to go into a recession or not. They finally updated this one, so I wanted to include it. We're a little bit above the black line. That's not the real concerning part. If we climb up here to 5, which is the red line, that's when we're headed more into a recession. And because there's a delay with this information, we're probably already going to know that before we see this chart. Looking at the forward earnings yield and then against the 10-year Treasury yield, as this is dropping, does that make bonds more attractive? Interest rates are going up, so they're not attractive right now. But if they continue to fall, meaning interest rates go up, there will be a time when people might step in and find them to be more attractive. Getting into our charts and analysis, here's the intraday chart where we did gap lower. We came up to the daily pivot. We're not able to get above that, and then we fell down and not quite to S2, and then we pretty much chopped around S1 for most of the day, a little bit below, a little bit above, and then closing right at about S1. One thing that I want to point out that I didn't mention in yesterday's video, the weekly pivot that we're keeping an eye on, I put that on this chart. We hit that last week, just a little bit underneath it. This is the pivot point that we're watching to see, is longer term resistance going to produce some problems for the market. Looking at the 10-minute intraday chart of the S&P, during the initial overnight session, it was pretty much flat. Then when we got into the pre-market session, that's when we started to see some more weakness in the futures. That carried over into the cash market. We saw a little bit of improvement near the end. And then some earnings came out that were not well received. So then we've seen some real drop off in the initial overnight session. Right before I started recording, we were down just a bit under 0.5% in the S&P futures. But this is still many hours before the market opens. It could get better. It could get worse. It could stay the same. Looking at growth versus value, growth is still outperforming with the blue line still on top, but please be aware that these two lines are on different scales, so it can skew the visual effect of what we're seeing here. But the fact that we did close just a little bit underneath the unchanged level just bodes better for growth. On a closing basis, growth was down more than value. The mid caps, it was also up a little bit less than value. For the small caps, it was down quite a bit more than value. Looking at the S&P growth to value ratio, where it did decline overall, and we ended up being down below the unchanged level, so that's more negative. Looking at sentiment, still not a lot of fear when we look at the Ulcer Index. The VIX ticked up on a down day, not a surprise, both with the line chart and with the bar chart, but we're still well below these moving averages, and the moving averages continue to decline. The VIX of the VIX didn't really do all that much. It ticked up slightly on the line chart. We saw a little bit of an uptick on the bar chart. Looking at the 5-period simple moving average of the equity put call ratio, this is continuing to advance, and that could be negative for the S&P 500. Longer term, we're back above this 0.55 level and advancing now, and again, that could be negative. Typically, when the S&P is going up, that's when this ratio goes down. But longer term, we're still looking okay. Looking at the MOVE index, where it did tick up a little bit, but not as much as you might expect, I'm still trying to get used to this whole MOVE index. I've looked at the VIX for decades, where the MOVE is kind of a new thing, so I'm trying to figure out the characteristics of how this thing actually moves around. When we look at the bottom and compare it with the VIX, we're seeing that they're pretty much neutral. They're not going in the same direction or in the opposite direction right now. The one fear gauge that we look at did tick up, but we still continue to decline overall. The other fear gauge that we keep an eye on is continuing to decline. The ratio between risk on and risk off is still showing some improvement and is holding up for right now. Our advanced decline line, we saw a bit of a tick down based on price and volume, but they're still looking healthy for the time being. The new highs, new lows, we are seeing a drop off in the new highs. We're flat with the 5-period. We're starting to decline with the 10-period. It's picking up these higher readings from 10 days ago and saying, wait a minute, these are lower readings, so I'm going to go ahead and decline here. The advanced decline ratio, we did come down, but we're still above 0. Accumulation distribution. We actually saw a little bit of an uptick here. That could be a sign of some internal strength, since this tries to measure what is the smart money doing. Looking at our cumulative NYSE advanced decline line, it did drop down a bit. We ticked down slightly with the NYSE advanced decline line, but we're still looking pretty healthy. And on the next chart, we're still above this advancing trend line. The common stock advanced decline line ticked down just slightly, also just slightly based on volume. We're also seeing more of a negative divergence here, where the advanced decline line based on price has been breaking out. That's not being confirmed by a breakout in volume. Looking at our advanced decline line studies, they're still holding up for right now across the board. They all came down, but they're still above their moving averages. Looking at our trend, the green line is still coming down, even though it's on top. The ADX is above its moving average and still giving us a pretty extreme reading. The shorter term, we're seeing pretty much the same thing, still above the moving average, green line on top, but declining. The volume still continues to drop off and is below average. Our short-term charts really didn't decide anything on this chart. It was a pretty slow day looking at the overall picture, and down at the bottom you see where we are below average with volume. Looking at the 20-period double and triple exponential moving averages, they're still going up. We've dropped a little bit below it. Will this provide some kind of support? Then looking at our moving average study, we declined a little bit with the 20, 50. We're no longer extreme. We're seeing a bit of a turn down with our 200-period exponential moving average. The stochastics, no longer extreme in the short term. We're turning up a little bit in the intermediate term, and yes, we're extreme. Turning back up slightly in the long term and continuing to be extreme. The force index did decline, but is still above zero. Some intermediate term charts. The balance of power did decline, but is above the dashed line. Looking at the 50-period double and triple exponential moving average, we're wondering, will this provide support? That's the blue line. That's the double exponential moving average. It has been providing support recently. Will that happen this time? And if we see both the red line and the blue line begin to turn down, that could switch things more negative. The go-no-go system remains more neutral with the lighter colored blue bars. We're dropping off a little bit from our highest high reading, more or less chopping sideways, but we're still above the midpoint. The TTM squeeze still showing some strength. We have the lighter colored blue bars and the oscillators continuing to advance ever so slightly. We're coming down into the second standard deviation now, so we're working off this extreme positive reading. The Erin indicator, no change with the oscillator, as we're seeing a decrease in buyers as well as sellers. This is a little more negative. With the S&P 500, we've dropped below zero with the McClellan oscillator, so now we're flattening out and starting to turn down based on price. We're already declining based on volume. I like to point out from time to time that the upper part and the lower part of this chart are calculated completely different. I like that because then this gives us more of an objective view of what's actually happening. These are two separate indicators that I put on the same chart. Looking at the NYSE McClellan oscillator, it did decline but is still above zero, so the summation index based on price is still going up as well as volume. We're actually seeing kind of a reverse negative divergence here where price is lagging behind the increase in volume. The Swenlin trading oscillator, based on price and volume, is declining. We're getting down to this point where we might drop below zero based on price. We are declining, but still above zero based on volume. The PMO is starting to roll over. We're looking more negative based on price and volume. We look at our PMO study. We're declining with the PMOs that are rising as well as the buy signals. We're still extreme positive with the PMOs that are above zero, but now it's starting to come down. The Elder Impulse system for the S&P has switched back to neutral. The parabolic SAR is still positive for right now, but if we have a significant down day and we see the dots change from being underneath to going over above, that's pretty significant, and this is an indicator that I tend to rely on pretty heavily. The slope oscillator continues to chop sideways, doesn't know if it's going to go positive or negative. The MACD is also looking a little bit more negative. So when we look at all of our oscillators, it's a little bit confusing in the short term. We're turning a little bit more negative in the intermediate term, but they're really flattening out. We're still leaning a little bit more positive in the longer term. The Sean trend meter has declined, but is still extreme positive. The NYSE bullish percent index did advance on Tuesday, and that's positive, and we're above 50. The chicken money flow actually is dropping below zero right now. This is another measure of what is the smart money doing. The fact that this is declining is a bit concerning to us. The chicken oscillator, based on price, is turning back up but is still below zero. The money flow index is dropping but is still above 50. Ultimate oscillator actually ticked up above 50. We're seeing a continuation of the pullback with the bullish percent index. After giving us a really high reading, it's starting to come down. We'll have to see if that continues. If we drop below this 70 level, that's when the official overbought signal will be generated. The vortex did decline, but the green line is still on top. Keeping an eye on the RSI 14 period and 9 period where we did see a decline, we're wondering if that's going to produce a shorter term negative divergence. So far, that looks like it's a possibility. On balance volume did decline, but is still above the advancing moving average. Looking at our 200-day moving average study, saw a bit of a decline. We also saw a decline with those stocks above their 50-period moving average. The copy curve signal has now gone away. It's dropping below the red line, so I won't include it if we stay below that going forward. But the Pring bottom fisher is still generating a buy signal. Our line chart, one chart to show you, we're now into the next cycle. We'll have to see. We came into that August 1st time. Sometimes we see a reversal when this happens, not always. Is this going to be the beginning of things shifting a little bit more negative, at least based on this cycle? But our different kinds of charts, they're still looking positive. The Heiken Ashi is positive. The Kegi chart, even though it's pointing down, is still positive. The Renko chart continues to be positive, and the 3-line break is also positive. So we're not seeing real follow-through based on price. We're just seeing some potential weakness under the surface. Looking at our different indexes, the equal weight as well as the S&P was down, but they're having a tendency to perform about the same right now. The equal weight ratio did tick up a little bit. If this ratio continues to fall and the S&P keeps going up, that could be a positive sign for the overall market because it means not just the big stocks, it means the broader stocks are starting to participate. Looking at Dow theory, we were up with the Dow, we declined with the transports, but they're still breaking out overall. We did see a decline in the utilities. The transports to S&P 500 ratio did tick down a little bit, but has been advancing. The transports are actually starting to outperform the Dow currently. Looking at our discretionary and staples equal weight study, we were down a little bit with discretionary, also down with staples. We ticked down a little bit with our ratio, but we still are seeing discretionary outperforming staples. The Dow did have an up day, even though it's not really going with any gangbuster movement. The diamonds continue to be neutral. The NASDAQ was down less than 0.5%. We're still chopping above this pivot point, but still below this overhead resistance pivot point. The cumulative new highs, new lows, they're still trying to show some improvement, but now we're starting to drop below zero when we take the new highs and subtract the new lows. We're still watching this 61.8% retracement level. We're far above that right now, but if we start to head lower with the NASDAQ, we'll be watching this. Looking at the NASDAQ 100, also kind of in no man's land. Above one pivot point, still below the other pivot point. Not much was decided. It was down 0.25%. The Elder Impulse system for the Qs, though, still remains positive. We're keeping a pretty close eye on the NASDAQ 100 right now because a large part of the NASDAQ 100 is also inside the S&P 500. Longer term, we saw these negative divergences. We've been following that for a while. Now, we're trying to see is something more short term starting to develop. We are seeing a little bit of improvement with the PPO down below. Can it cross back above its moving average, or our price is going to continue to fall and we'll see this PPO continue to decline? Looking at the NASDAQ 100 bullish percent index, we're still extreme positive and we rolled over a bit. It won't become an official overbought signal until we drop below this 70 level. Small caps were down about 0.5%. They're also in between pivot points. This was a little more disheartening. On Monday, we saw the Russell 2000 close above this resistance level, only to give it back on Tuesday. We still are working off of a golden cross. The RSI, after almost getting up to 70, is now dropping back down, but it's still positive since it's above 50. The MACD is trying to turn back more positive, but it's not really that convincing yet. The small caps, which had switched over to positive, have now gone back to neutral for the Elder's Impulse system. The small cap to S&P 500 ratio did tick up a little bit, but we're still declining overall. Looking at small cap growth to value, where we're just chopping more or less sideways, we're still in an uptrend, but we've been seeing a lot of sideways action with some recent weakness. The mid caps, they're still above this pivot level and held up even though they were down 0.25%. And the Elder Impulse system for the mid caps has gone from being positive back to neutral. When we look at mid-cap growth versus value, it actually was up, and we got back up to this 50-period moving average of this ratio, and they're still in a longer-term uptrend. The dollar had a pretty good day, up 0.45%, got above the 102 level. Looking at the FANG index, we have not been able to get back to this previous all-time high, let alone break through and try to set a new all-time high. Looking at growth versus value, it did turn back up and showing some improvement. Overall, growth is outperforming value. Looking at the S&P to bonds, we're still seeing this ratio going up, suggesting that the market thinks there will be a soft landing. Home construction also is outperforming bonds, suggesting that the economy is still looking good into the future. Keeping an eye on the banks, we did come right down to the 200-day moving average after it had a nice little run-up. When we look at the financial sector, getting close to a golden cross here, but it hasn't happened yet. Looking at the financials and comparing it to the S&P, did tick up just slightly, but still in a longer-term downtrend. Looking at the regional bank ETF and comparing it to the financial sector, we did tick down a little bit after it's been showing some improvement, but we're in a longer-term downtrend. Keeping an eye on bonds, this is where some action happened here. This is the 10-year yield where it closed above 4%. When yields go up, prices go down, so we've seen a decrease in prices. We're dropping below 50 with the RSI, that's negative, and the MACD is also negative. Looking at the value to growth ratio, we're showing the 10-year yield and this ratio going in opposite directions of each other. Also keeping an eye on the S&P 500 to the long-term bond ETF, we thought the longer-term relationship was getting stronger. Looks like you're having a little bit of a breakup here. And then on a shorter-term basis, we're seeing that relationship going in opposite directions. The spread didn't really change all that much, but it's still quite wide. This is another chart of concern. We're seeing this ratio continuing to advance. When we look at cash and compare it to the 3 to 7 year bond ETF, if the market was more certain about interest rates, this ratio would be going down. It's in fact going up. And then just to show you this is the 3-month yield where it's just going higher and higher, well above where it was back in 2007. Our long-term charts, the special K daily chart is still positive. The weekly chart is showing some improvement, but it's still negative. Here's our longer-term moving averages. We are declining with the 150 and 200, but we're still above this red line. Again, there's nothing magical about these lines that I put on here. I put them on here. They're just guideposts when we've gone either up or down a little too far too fast. They're just arbitrary lines that I came up with. This is the chart that I've kind of been focusing on ever since I did the weekly video. Last week we came right up to this R1 level, and we've not been able to get back above it now. In fact, we're dropping down below it. Is this longer-term resistance going to cause more problems? Looking at the NASDAQ 100 to Dow ratio, also after coming up to a real high reading, we are declining slightly. When that's happened before, that has been really negative for the market. We'll have to see if this picks up steam and starts to drop lower. Looking at the NASDAQ weekly chart, still above this resistance level. That's holding up for now. And the S&P is still above this resistance level too. You could call it support, but I'm calling it resistance until we've been here for a long time. An update of our possible positive scenarios. We saw pretty much flat with the Qs to the S&P, a little bit of a tick down with discretionary to the S&P, and also coming back down to the moving average when we look at large cap growth versus large cap value. Our growth to value ratios, a little bit of a decline with the large caps, a bit of an improvement with the mid caps, and we're just kind of chopping around the moving average with the small caps. The S&P to utilities ratio continues to go up. This could still give some support to the S&P. The 10-day average of the S&P 500 highs minus the lows, we're still getting a very high reading, and we've been up here for over a week now. When we look at the broad range of the 5-period moving average of the highs minus the lows, we did decline, but we're still above zero. The 50-period exponential moving average of the new highs minus the new lows continues to advance. This is a longer-term indicator, so it takes more for this to start shifting. When we look at the black line, we did decline, but we're still above zero. That's what's keeping the red line going higher. The S&P growth to value ratio did tick up just a little bit, but as I keep saying, we're in an uptrend overall. Ever since about the middle of April, we have been dropping lower in this ratio. Looking at the Staples to S&P 500 ratio, it did decline. It's been in a real decline overall. That often gives good support to the S&P. So what's our outlook for Wednesday? There will be some big-time earnings reports that will be released on a stock-by-stock basis, including Apple, Amazon, Merck, and Qualcomm. There's no scheduled Fed speeches for the month of August. The technicals are positive, and right now it looks like we're working off of that extreme positive reading. At the same time, we're starting to ask ourselves, is weakness starting to develop? Looking at the economic reports that will be released, we'll get the weekly MBA Mortgage Applications Index as well as the ADP employment change. And then we're always keeping an eye on the geopolitical events, but the market is still fixated on inflation and a little bit more right now on interest rates. Here's the updated economic calendar for the week. Remember, on Thursday, we'll be getting the ISM non-manufacturing. On Friday will be the big employment situation report. Looking at the Stock Traders Almanac statistics for August 2nd, we're neutral to positive with the Dow, and we're neutral to negative with the NASDAQ. Here's a graphical look at kind of that same thing, where we do see weakness for the NASDAQ coming into the latter part of July and the beginning part of August. We're in that window right now. We will be on the second trading day of the month, where in a pre-election year, we do tend to see some weakness. The first statistics that I showed you are overall. The dashed lines are what happens in a pre-election year. Going back to 1950 in pre-election years, the S&P is up 50% of the time and down 50% of the time. So our scenarios, can't really go with the down one yet. We're working off being overbought, but is weakness starting to develop? Not seeing a lot of confirmation of that yet in our charts, but we are seeing some weakness potentially starting to develop. So for right now anyway, we still default to the positive side because our charts are still looking more positive overall. We're not going with the sideways trend because the ADX, it's up above 40, it's above its moving average, even though the green line is declining. The warning signs, are we going to see this convergence of these short-term bearish signals? The longer-term trend signals, both for the NASDAQ and the S&P 500, we're still above those levels. We're in a seasonally and historically weak time of the month. The S&P 500 oscillators are switching back more to negative. We're really keeping an eye on the NASDAQ 100. The VIX is still showing that there's not a lot of fear right now. The cumulative new highs and new lows for the NASDAQ are still showing longer-term weakness. Yesterday it looked like maybe we're seeing some improvement now. Now that's kind of into question. The 3-month yield is above where it was back in 2007, and it's even going above that now. S&P growth is weakening, but it's still in an uptrend. The weekly pivot, that's the longer-term chart. It may be acting as overhead resistance. We hit that level last week and have not been able to get back up to that point. The concur buy signal has now ended. And then earnings season is on a case-by-case basis. Positive signs. We are positive when we look at seasonality and the setups that remain in the background. The special K daily chart is positive. The weekly chart is still negative. The longer-term equity put-call ratio continues to decline, and that's positive. The S&P remains above the downtrend channel upper line. We're still in a risk-on posture, and that's positive too. Lower price levels may provide support. We haven't really tested those yet. 0.25% decline is not a testing of support. If we really start going to the downside, we'll have to see what levels may provide some support. So far, we can say that support is holding. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're still above resistance, but they're still below the daily resistance. They're both kind of in no man's land currently. The Staples to S&P 500 ratio is declining, which should give some support to the S&P. The Russell 2000, as well as the small cap index that we look at, in addition to the mid caps, have generated recent golden crosses. Small cap and mid cap growth continues to be positive. The Pring bottom fisher has still generated a buy signal. Notice the Kopic curve is not on this list any longer. So our conclusion, the S&P remains positive for right now, and it looks like it's just working off being overbought. But is there weakness starting to develop? In the short term, we can say pretty much the same thing, as well as in the intermediate term. We're still positive in the long term because we're above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.